Welcome, everybody. The Winning Momentum Podcast with your host, that's me, Scott Sinclair, episode 223. I just shot this show for about 45 minutes before I looked over onto my fancy Rodecaster over here and noticed that I had not punched record. So here we go. Take two on this. The first show was great. I hope that this show works out well. I haven't done a show in a couple of weeks. That's maybe why I forgot to push record on my Roadcasting podcaster. And the reason I have not done an episode in a couple of weeks is I was traveling. I was across Canada. I was into the United States, largely into Florida and to New York. And on that extended business trip, what was I doing? Well, in part, I was working on deals. I was in negotiation sessions. I was listening to pitches. I was reviewing assets as part of a due diligence process. And that is what we're going to talk about today. What is due diligence? How should we think about it? How we might go about it? I've been just listening to all sorts of pitches and going through due diligence in 2023. And it is really amazing to me how if you're not specifically in the M&A lending business, investment banking business, you know, a lot of professionals, a lot of business owners, a lot of executives, a lot of angel investors, they really don't have a process to follow. It's sort of haphazard. And they don't really have a clear understanding of what they're trying to accomplish with due diligence. At the end of this, I'm going to read to you some questions from listeners about due diligence, and you'll see that they're focused on trust, the ones that I selected. Well, if you don't trust somebody, don't do business with them. Period. Due diligence isn't going to help that. Due diligence is not just about finding red flags and finding out whether you trust somebody. There's an element of that, but it's way more comprehensive and way more important. So let's dive into this. What is due diligence? Due diligence is a process typically used in a business or legal context to evaluate and investigate a particular situation, an opportunity, or a risk. Okay, so think of it as a process, really in any material transaction in your life, to help you evaluate and investigate the situation, the opportunity, and the risk that goes along with it, okay? And so the broad goals, if I can put it that way, would be number one, to obtain a comprehensive understanding. You'll see me checking my Rodecaster regularly now to make sure it's still on record as if it would go off by itself. To obtain a comprehensive understanding of the situation or the opportunity. So you're gathering information, whether that be private information from your counterparty yourself. If you're looking at investing in somebody's deal that they have pitched to you, you get to ask them for information. You get to ask them for a data room, right? You look at public information. We have a fancy database that we pay a lot of money to, and we can search any public company in the world, and we can effectively, and a lot of private companies as well, and we can compare public data to the claimed private data and see if things make sense. You do some analysis, you do as much information gathering as you can, and that gives you a understanding of the situation and the opportunity. Next, the purpose of due diligence would be to identify and assess the possible risks or concerns. And I'm going to talk about that a lot. I think that if you're not experienced, you're often looking for red flags and a way to walk away from the deal. What you're not looking for and what you ought to be thinking about is identifying risks. How do I identify the risks? What are they? How do I quantify them? If that risk happens, how much does it really cost? What are the consequences of that risk manifesting? And how do I mitigate that? What can I do if that happens? Let me tell you something. There is no deal that is perfect. There is no deal ever that is perfect. There are deals that happen that I have done that have worked out perfectly, but that doesn't mean that they couldn't have gone the other way. All right. So for me to say, wow, that was a perfect deal. Well, that's just crap. That was luck. Okay. Now, did I structure my affairs so if it went the other way, I protected myself? Yeah, as best I can. That's the mitigation. Okay. No deal is perfect. If you're looking for the perfect deal, you won't do a deal. You either did it because you missed the risk or you've identified it and decided you don't care or you found a way to mitigate it. Happy Easter and happy Passover, by the way. I hope everybody had a great weekend. I should have started with that. Personally, I was off with a cold, which is why I'm sounding a little rough today, just to give you a heads up on that. So identify, quantify, mitigate your potential risk. Ensure, another point of due diligence is just to ensure that the transaction that you're about to enter into, or the contract that you're going to enter into, is, fits within your environment from a legal perspective, a regulatory perspective, an ethical perspective, a values perspective. Does it meet all of those needs? Check those boxes. That would be a point of due diligence. Does it provide you, the due diligence process is intended to provide you with sufficient information to choose between competing opportunities, right? So if you're in the middle of a sale process or a financing process, and you could do option A or you can do option B, well, the due diligence gathers that information and helps you make the decision that this is the right thing to do. Let's do A versus B. And it also promotes transparency and accountability, particularly in a larger corporate environment. Are you going to go to your board of directors and recommend you buy another company, you do a deal based on that company's PowerPoint deck? Or might you do some due diligence and pay the accountants and lawyers a whole bunch of money to make sure that you've made the right decision and to cover your ass? I mean, that's a large part of it, okay? So that's just an idea of what due diligence is. In what situations should you be doing due diligence? All right, and the answer, in broadly speaking, is going to be in any transaction of any substance in your life. That's when you should at least be thinking about due diligence. You should be thinking about, what are the risks? How can I quantify those risks? How can I mitigate those risks? I just keep coming back to that. Let's look at some examples. You're an angel investor and you have been asked to invest in somebody else's transaction. Here's my pitch. Here's my PowerPoint deck. I need $500,000 from you. Do you just say okay? Or do you think about it in a due diligence framework that we're outlining and talking about today? That would be a need for due diligence. If you are in the business of lending to a company, if you're a financial institution, a boutique lender, a high net worth individual, and you do bridge loans or secured loans or sub-debt loans to businesses, you're going to want to do, it's the same as the angel investor, you're going to want to do some level of due diligence to support that loan. If you're buying a company, if you're merging businesses together, you need to do some due diligence for a whole host of reasons, for all of the objectives that I talked about at the beginning of this. If you're selling a company, you're getting a bunch of cash, maybe you don't care so much. Maybe you want to know the source of the cash, so you're not doing something nefarious. But if you're getting out, it's a good deal from a valuation perspective. Maybe you don't need to do a ton of due diligence, but I'll tell you what you do need to do. You need to be prepared to facilitate the buyer's due diligence. They're going to do due diligence on you. So, due diligence is relevant to any transaction of any substance, whether you're on this side of the table or that side of the table, on the buy or the sell, the bid or the ask. You're either doing the due diligence or you're providing the materials for the due diligence and answering the due diligence questions, or you're doing both, right? In a merger, you need to be doing both. It needs to be a mutual due diligence process. What about hiring a key employee? There's a material decision. A transaction of substance does not even, there's a monetary element to it, but it's not a lending deal or an investing deal or a buying or selling deal. But, when we do transactions now, we take a client or one of our companies to a lender or to an equity investor. What's one of the first things they do is they run out and they hire the investigators on the key individuals, including me, right? And they do criminal research, security searches, bankruptcy searches, lien searches, tax searches. They do all sorts of due diligence on the individuals before they connect themselves with that key party. Okay, so hiring a key employee to run your business, maybe there's some level of due diligence that you ought to be doing on that. Strategic partnerships might be another one. What about key service providers? You know, I get bombarded 10 times a day with service providers from LinkedIn, from foreign countries that are going to take over my social media. And, you know, one of the things that I think to myself is, who are you? And why would I ever tie my wagon to your horse, so to speak? Can we still say that metaphor? I think we can in today's world. But why would I do that? I can never do due diligence on you. I could never rely on anything. I can't quantify, I can identify my risk, which is a whole host of problems, but I can't quantify them, nor can I mitigate them in any way. You're not going to survive due diligence in being a key service provider to me. So as I said, any transaction of any substance is an opportunity and a need for due diligence. And again, whether you're on the buy or the sell, you know, you need to understand the due diligence process if you're doing due diligence on a party, but you also need to understand it to be able to support due diligence that someone is doing on you. And that's key. You know, deals are about momentum. Deals are always about momentum. If you start a deal and everybody gets excited and then someone says, okay, well, send me this list of information, and you can't do that for 4 weeks, your deal's dead. People move on to other things. They're busy. Maybe you can resurrect it once. Maybe you can resurrect it twice. But so often deals fall apart because the people on the sell side, right, the company that wants the investment, the company trying to sell their business, the people that need to provide the information for the due diligence process are simply not prepared because they had no idea what the hell due diligence is. It never occurred to them, or they don't care, and their deal's dead. I see it every day. All right. So what are the broad goals? I talked about that before, but I want to talk about a concept. I did a social media post and I said, due diligence should be done in layers. People thought, oh, well, that's interesting. What does that mean? I'm gonna make up an example. I made this up live on the spot on the episode I just failed to record, and I don't know why it came to me. I know nothing about automotive repair garages. But for some reason, I said, let's use a hypothetical example. Let's say you have an automotive repair garage and you want $1 million of my money to invest and expand your business. All right? Weird hypothetical example for me. But let's say that's true. I've been in so many meetings in 2023, actually in the last couple of years, where a team of potential investors have heard this sort of pitch. So it's outside their comfort area, right? It's outside of their area of expertise. And then inevitably somebody starts in and says, well, that's very interesting. Thank you for your deck. That shows me your revenue now and your EBITDA and where that's going to grow to with my investment and how I get out in 3 years and my return on investment, which is astronomical. I'm really excited about this deal. Let's dive into this. How many bays do you have? Okay, you got 4 or 5 automotive bays. What's your revenue come from? Does it come from oil changes? Does it come from transmission rebuilds? What drives the revenue? Oh, okay. How many mechanics do you have? Where do you get your labor, right? And you start going through these specifics of the business. And, and you not once have you talked about whether this deal makes any sense, right? There's so many things you should be talking about before you're wasting your time on this level of specificity. It just makes no sense. Now, I've been doing this for over 30 years, deals, I mean, and I can look at a transaction pitched to me. I can look at it in probably 30 seconds or a minute, and I can understand the problems. I can identify my risks. I can identify for myself. Maybe I can't quantify them off the top of my head without doing any work, but I'll know if I can mitigate, right? I know if I can cover myself on that particular risk. And that's where you need to start. You need to start with just assume that everything they tell you is 100% true. Start there. Everything that was in that pitch deck is 100% true. Everything in the financial projections and the historical financials are 100% true. Everything that prospective key employee or service provider told you is 100% true. Just start there. Now, if it's true, does the deal make any sense for what you do for a living? What you need, what your business plan is? Does the deal make any sense? So for example, a few weeks ago, I was pitched what at first seemed like a very interesting transaction. I was with a group of possible investors, and everybody was super excited about it. There was a big name associated with the deal. Everybody was excited about this or jumping up and down. I volunteered, raised up my hand and said, I'll lead due diligence, because I could tell sort of 30 seconds into this that there was going to be some material flaws, certainly in what I'm interested in. I'm not saying it's not awesome for somebody else. I'm saying for me, there's some material flaws when I compare it to what I want to do for a living and what I want to invest in. And my suspicion was there was material flaws in the deal for the way everybody else in my little investor group, significant investor group, was also thinking about possible transactions. But I didn't want to do that in 30 seconds. I actually spent 2-3 hours on this, reading all of the documents, going through all the materials, going through all the projections. And I did zero verification. I just said, okay, let's assume everything you're telling me is 100% true. Everything's 100% true. Does the deal make sense? Oh, wait a minute. There's no security on this transaction. If something goes wrong, I'm not going to get my money back. I'm just purely an equity player in this deal. And by equity player, I mean a really, really, really small minority equity player who has no board representation, no ability to influence management compensation, no ability to change management, fire management, no ability to vet and approve material contracts, no ability to see a budget every year, approve a business plan, right? I'm just a bit player, a passive investor in this larger transaction. Maybe that's okay for some people. Also, key to this was I wasn't, as an investment in this company, I wouldn't be able to force an exit. There was a possibility of an exit 4 years down the road, but there was also a pretty good possibility that exit didn't happen. And then what? You're just stuck there. There's nothing else that you could do. You just cross your fingers and you wait. And maybe some people like that from a passive, hands-off investment type perspective, okay? But not me. And as it turns out, not my investment group. And the reason I wanted to spend time on it was I wanted to make sure that I was right. I didn't want to be flippant about it because there seemed to be serious, real people involved with this thing, and they deserve the respect of somebody doing some work on their transaction, which I did. And I verified that my hunch on the thing was absolutely true. Okay. And not only that, by the way, but I later spoke with the principal of the deal that was pitching it to the investment group. And I said, hey, here's what I said. And here's what I was thinking. And the guy back to me said, yeah, you know what? Those are all great points. And I said, it's not that your deal's not awesome. It might be awesome for you. It might be awesome for other people, but it's not awesome for me. And it's not awesome for the investment group, or at least the majority of the investment group that I was working with at the time. And so from the very top down, if everything they say is true, your first layer of due diligence should be, does this even make sense for me? Okay. Layer number one. Layer number two comes in two parts. Both parts relate to identifying your risks, quantifying your risks, mitigating your risks. Identify, quantify, mitigate. To me, it's the heart of due diligence. Identify, quantify, mitigate. I say comes in two parts, layer two, A and B. The first part is on the deal itself, and the second part is on the underlying business. All right, so the deal itself, let's just say I got over my hurdles on this particular transaction that I referenced that had all of the passivity issues that I don't like. Well, what if I was able to push back on some of those issues? I've identified my risks being passive. I can't exit. If something goes wrong, I'm going to be diluted like crazy in the future when they have to go raise more money. These are risks that I can identify. I can quantify in the sense that it's somewhere between 0 and 100%, right? Which is sort of also the same as not being able to quantify. But how might I mitigate those? Well, I could mitigate those by changing the entire deal, okay? And so I can push back, I can identify and quantify those risks, and I can push back on the deal side of this, and which we did to some extent, even though I knew we weren't going to get far enough, but I wanted to go through the process and give everybody the benefit of the doubt. And we got some repricing. We got a change to the waterfall to add some protections. We pitched out a put. Hey, why don't you give us a put option? So if you don't exit, doesn't work as planned, we can at least get an exit from you. Maybe I'd rather have a convertible debenture, something secured over some assets over here, which aren't part of the deal, right? And so I've identified in phase one, in layer one, through my due diligence, that the deal doesn't make sense to me. And in truth, I identified that it was so far off base that we would never get there. And I was mentally done with the deal, but still we went to phase two for good form. And in case other people within the investment group fairly wanted to step up and they thought differently than me, right? So we went to phase two, which was identifying and quantifying deal risks. Again, not verifying anything, but based entirely on the representations, can I find a structure to mitigate those risks that I identified in the deal? And then on to the next point. So I said 2 layers, layer 2 into A and B. Well, the B part of that, again, identify, quantify, mitigate risks on the business itself, because I've only talked about the deal on this so far. Well, there was an underlying business, obviously. And what about that business? Again, not trying to focus on verification, not trying to focus on red flags, but assuming everything they say is true. What business are they in? What are their projections? Do the projections make sense? Or are they completely out of lunch, like what we say in the business, a hockey stick projection that obviously tells you there's a management team that's not making any sense? Does the EBITDA make sense? Does the cash flow make sense? When they run out of money in the future, which is a risk that you always have to worry about, right? Because companies don't focus on their working capital when they're doing these things. They focus on their profit and loss. They focus on their valuation, right? And many companies end up running out of money and going bankrupt or going through a restructuring because they grew too fast. Not because they couldn't grow enough. They didn't account for the working capital. New money has to come in to fix the problem. On the battle of new money versus old money, who wins? The old money gets diluted and you lose all your value. I don't want to be in that position. That's a risk that you need to try to identify, quantify, and mitigate. You want to look at material contract risk, customer concentration risk. Oh, wait a minute. 80% of their revenue comes from one customer. As you start sort of diving into this, based on everything that they tell you, right? Oh, look at this whole deal is premised on one right to use contract from somebody else. What happens if that goes away? What do I have for a business then? You want to look at key assumption risk. And, I'm working on some merger deals right now in the hemp industry, and everybody in the hemp industry seems to be in more or less the same boat. They're small companies. They've capped out at revenue at a certain amount. They lose a bunch of money, which is probably more than even their revenue. And that includes my hemp company, although it turns out that my hemp company, which has been in serious trouble, is not as bad as most of the rest of the market, oddly enough. Really surprised me. And so kudos to my team on that. But everybody in the industry agrees that the real plan here needs to be a roll-up. Needs to be a roll-up program. So what does that mean? You take 1 or 2 or 8 of these smaller businesses and you merge them together. You get rid of the redundant costs, and all of a sudden you're a mid-sized business and you're not losing money because you got rid of a bunch of redundant costs, and you create a brand, and you could be last person standing in this whole industry. And so there's a business plan, and everybody kind of has the same business plan in that hemp space right now. So to go through the due diligence process for that, this is a merger conversation, right? So you say, okay, I'm company A, you're company B. here's my financial statements from the past, and there's all the money I lost. And they say, well, here's mine. Here's my financial statements from the past, and here's all the money I lost. Okay. Now, my plan for 2023 is this budget, this pro forma financial statement. And there's what I'm going to do. And it shows that I make money. I make money. And here's my assumptions. Here's what's changed. I'm going to do this. I'm going to buy this capital equipment. I'm going to make these changes. And when I do all that, based on history that I can justify, it shows that we make money by ourselves. Okay. I'm not asking you to believe that. I'm asking you to look at it, to understand the assumptions and the changes that drive that profitability. And now those are your risks. You can identify those changes. You can choose to believe them or choose not to believe them, but you can quantify what happens if things go wrong, and you can judge yourself accordingly. And you do the same for me. What is your pro forma for 2023? And what they send me is basically something that says they just plan to lose a bunch of money. They have no plan. They just plan to lose a bunch of money. And by the way, run out of money. They don't have that money that they're going to lose. And not just one company, by the way. If you think I'm talking about you, I'm not. This has been multiple conversations. It's always the same. If that's what you do, I can't do due diligence on that. All I can say is, you've presented me with a plan to lose a bunch of cash that we don't have, right? I presented you with a plan that did the opposite, and I identified for you the changes so you could start working on understanding those changes and the risks associated with them and decide if you want to do the deal. I don't even get the benefit of that doubt. So your first step, your first layer of due diligence, the way I want you to think about it, believe everything they say. Does the deal even make sense? If you want to go to layer 2, it comes in 2 parts. Not arguing, not pushing back on anything they say. Can you identify your risks, quantify your risks, and mitigate your risks, A, with respect to the deal, and B, with respect to the underlying business? And then your third layer of due diligence gets into the nuts and bolts of verification. This gets into just everything, okay? And this is the hours. Whatever I described before, I'm experienced enough that I can do that on a new deal in 15 minutes to 30 minutes, depending on the complexity of the transaction. I just know. I know where the deal makes sense. I know where the valuation makes sense. I know what the risks are. And part of the verification process is you're going to find potentially more risks, but I've already identified what I want to do, whether I can mitigate them, and whether I want to spend the potentially hundreds of hours in going through the verification step or layer of due diligence. Hundreds of hours, Scott, you say? Yeah, this is the part where people hire accountants and lawyers to go out and dig into everything. And, at Sinclair Range and any professional firm worth its salt, they will have a due diligence checklist that's, 20 pages long, 100 pages long of just row items that takes you through everything. The corporate registry, shareholders, legal framework, regulatory framework, insurances, real estate, all that sort of stuff. And that's before you even get to the financials. You do verification on each line item and sub-line item in a financial statement. What's the first line item on a balance sheet? Cash. So the checklist is going to say, where are the bank accounts? Write down the bank account numbers here. How many banks are there? What jurisdictions are there in? Get 6 months worth of bank statements, right? You review those bank statements. Do you see any unusual transactions, right? That's how you go about the verification on a bank side. Accounts receivable. Get me the accounts receivable subledger. Let's look at 12 months worth of accounts receivable subledgers. Let's get a listing of credit notes. Let's calculate our AR, accounts receivable dilution. There was an episode on that way back in the Martinis with Scott days. You can look that up. Okay. Let's do some third-party verification of the amounts. Says here that company C owes you $400,000 on April 10th, 2023. Hey, company C, do you owe this company $400,000 today? Yes or no, or send them an email. You do these, and you just do this through every account in the general ledger. Everything. Okay. Intellectual property lists, brand names, everything. That is what verification is. Why would you spend the hundreds of hours on larger transactions? You can spend hundreds of thousands of dollars. Why would you do that layer of due diligence without the first layers of due diligence, which someone like me could do in maybe 30 minutes? Because if I don't get from here to there, why would I spend that money and that time? And in fact, from the first two layers of due diligence, what you should often be doing is that's when you draft your term sheet. That's when you say, okay, you've told me everything is true. I've taken your word for it. I'm good with that. We've talked about risks in the deal. We've talked about risks in the business. We've talked about how we're going to structure this thing so it makes sense for me and it makes sense for you. Let's put that into a written term sheet, binding or non-binding, all of it subject to due diligence, meaning verification at that stage. And let's see if we really agree before I spend the time and the money to go through this verification process. Okay, so your third layer is verification. Now, at the end of that, are you done? No, you are not. At the end of that, I told you before, there's no such thing as a perfect deal. You will have found risks that the quantification is above your threshold, right? I need to make an investment in this business. There's a particular risk. If that goes sideways, it's going to cost this business $500,000. That's too much for me to accept as a risk, but I can mitigate it by doing the following, okay? So you're going to find those sorts of risks. You're also going to find risks that are either unquantifiable or that you can't mitigate, or both. And those could be deal killers, okay? But that's part of the process. You're going to come out with, what are my risks? Can they be quantified? Can they be mitigated? And then your last step for those risks is to think about, in my ultimate legal agreements, what will my representations, warranties, and indemnities be? And what are those things in legal agreements? Really, no matter what jurisdiction you're in, it's the same concept. They may be called different things somewhere in the world. But the concept is we've identified this risk. So the selling company or the company receiving the money says, we represent that fact is true. Okay, that's what it says in the legal agreement. And if you find out later it's not true, we're providing you a warranty on that and an indemnity, which means we will pay you that money to deal with the fact that representation was wrong. Okay, and you quantify that in some way. And then the idea is, well, how do I secure my indemnity? Or is my indemnity unsecured, which means it's all nice to have on paper, but I'm never going to collect it, right? But that is the last step of this. And so if we focus on due diligence as being, what are the risks? How do we quantify them? How do we mitigate them? That last legal piece and the related indemnity is a big part of that, right? You could just put it into that basket if you have faith in the indemnity. So to summarize the layers of due diligence, does the deal make any sense? Assuming everything they tell me is true, can I identify, quantify, mitigate my risks on both the deal and B, on the company itself, assuming everything they say is true? Yes, let's move on. I've got a term sheet. Let's move on to verification. Now we're going to find out if everything they say is true, and then structuring my legals reps, my reps and warranties and indemnities to sort of cover me on everything that falls through the cracks. Don't confuse those steps. Do not jump ahead. You're just wasting your time. And what you're going to do is you're going to end up investing weeks into a transaction that was never going to work from day one because you're focused in the wrong areas of due diligence. And what I find people do, particularly angel investors, by the way, high net worth individuals, is their due diligence falls back on the areas that they're most comfortable with. Okay, I didn't understand 80% of that, but I'm an expert in this 10% over here, and that bang, bang, bang. That's what their due diligence is. Why? Because they're looking for red flags to not do the deal. No deal is perfect. You will always find a red flag. That's no trick. Okay. Now, you might find out that the counterparty is a liar. Different issue. Okay. Different issue. But 100% of the time, you're going to find out that you have a different perspective on things, that things aren't true the way you see it, but it's true the way they see it. No deal is perfect. And rarely does someone pitching the deal identify the risks for you up front. We like to do that in our practice, by the way, but rarely does that happen. So that's what due diligence is. And by the way, that's what you're doing if you're doing the investigating. If you are being investigated, you still need to understand that, and you need to prepare in advance. Like, you literally need to create a data room. Okay. A data room in the old days was a bunch of filing cabinets in a locked room. And when you got to that point of the deal, someone could go and sit in that boardroom, in that locked room at a table, and pull out one file at a time and go through everything. Okay. Now, of course, it's all electronic. There's all sorts of services for that. We do ours in Dropbox. We try to keep it simple. But on the sell side of any transaction, you just need to remember that if you're dealing with anybody with any amount of sophistication, they're going to want to do some due diligence. And if you're not ready for that due diligence, your deal loses momentum, which kills sales. So prepare in advance. Have a data room in advance. Have everything deposited into the data room. Have a good table of contents so people can follow along. And then, as people ask you questions that you hadn't thought about, don't just email that to them. Put it into the data room so everybody has the benefit of that. Okay? So that's my review of due diligence for you. And I hope it's been valuable. Now, a couple of weeks ago when I was thinking about doing this show or this topic, I threw out a comment or a post onto LinkedIn, and I asked people, I'm going to do a show on due diligence. What are some things you might like me to address? So one question was, how do you do diligence? Not how do you do due diligence? How do you do diligence? A private company when you are not sure if you trust their financial reporting. Okay, so you're not sure if they trust their financial reporting. Well, you need to think about that sort of, I can interpret that question in two ways. One is, I don't trust their financial reporting. I trust them, but their financial reporting is shoddy. Okay. Or I don't trust them at all. And that manifests itself in the financial reporting. In other words, I think they made it up and they're lying to me. Okay. So both of those are a problem, but if it's the second problem, if it's the latter, if it's you actually don't trust the individuals, you think they're trying to defraud you or they're just liars, those are those hard red flags. My question back to you would be, why would you do business at all with somebody that you can't trust, right? There's always an element of trust in negotiation. The due diligence is to try to identify those risks and to quantify them, to mitigate them. But I grew up professionally as an auditor, as an accountant and a CPA, and they used to tell you in the audit world that audits are not designed to catch fraud. If a company's trying to defraud the auditor and they're good at it, they're going to get away with it because auditors really are not very set up to catch hard frauds. Well, it's the same in due diligence. You're not going to catch a hard fraud, probably, right? You're not going to catch a fabricated invoice, a fabricated shipping document, a fabricated material contract, faked bank statements. Like, you're not going to catch that sort of stuff for the most part in a fraud. So if you don't trust the person, in a due diligence process, so if you don't trust them, why would you even get involved? Okay, that's thought number one. Now, thought number two, I said there's another part to this. Maybe it's just shoddy financial information because they're incompetent. Look, I buy troubled companies for a living. I'm buying companies from people I don't trust or people who are just terrible at financial information. How do I do that? I identify the risk. I don't trust these people at all. I don't trust their financial information because they seem like good people, but they're not very good at that. How do I quantify that risk? Well, you can do that account by count. How do I mitigate it? Well, it comes in the price. It comes in the price. If I can't rely on your financial information, I'm not doing the deal unless I'm knocking a whole bunch of value off of the purchase price. Because I'm only going to do a deal on what I can believe, right? Then you could negotiate a variable component to the purchase price. You could negotiate an earnout, for example. You can negotiate a post-transaction rep and warranty and indemnity so that you hold back a big chunk of the purchase price for 6 months or a year to see if the financial information is true or not true, and have a 1-for-1 or some factor of adjusting the purchase price downward for which you've held back the money because of this incorrect financial information. So in your question, you've identified the risk already. And if it's because the people are just simply not trustworthy, I would ask you why you're doing business with them at all. If it's that they have shoddy financial information that you don't trust, that's an identifiable risk. It's a quantifiable risk, and you can mitigate it in the deal. Okay. So another question I had along the same lines is where do you draw the line between due diligence and trust? If you don't trust them, don't do the deal. Okay. That's number one. But then on the other hand, I sit through these investor meetings. I hear, I have angel investor friends, and I just hear this nonstop complaint these days about, I went into this deal and I relied on this person and they really screwed me. They really screwed me. I'm just never going to trust people again. That's on you. If you're investing in something without doing due diligence, that's on you. You do not draw a line between due diligence and trust. You trust unless you can't trust, and then you don't do the deal. And even if you trust, you do proper due diligence anyway. That's a false question in my mind. What are the best tools to protect yourself from skeletons that may arrive outside of a median lengthy VTB? That's a vendor takeback, and aggressive legal team. Well, I think we talked about that. We talked about the structure of the transaction. We talked about the reps, warranties, and indemnities, which is now you need the aggressive legal team that you referred to. We talked about deferred conversation, which was the VTB. That's what you can do. And on the if you're on the sell side and you end up with the vendor take back, then you want to have that vendor take back secured. You want to have rights and remedies if they default on that, and you need to act on your security. You want a share pledge as part of the security that goes along with that vendor take back note. If you're on the buy side and you're issuing a VTB, well, what are you doing? You're really, that's a holdback on the purchase price. That is financing your indemnity that we talked about. So you got the reps. Everything you told me is true. That's my rep. Oh, turns out something wasn't true. Here's the mathematical mechanism for me not to pay you on your vendor take back note, right? And then you say you need an aggressive legal team for that, but you don't. It's in the contract. They need an aggressive legal team to come after you to say, hey, that's not true, right? And you need to fight that. But the trick to that is you're holding their money back, which gives you some power and some protection. What else do I have here? What are some of the common mistakes that people make during due diligence, and how can they be avoided? Trusting too much. I think we've covered these already. Trusting too much, doing a deep dive into some frivolous verification that doesn't matter before you've even thought about the whole transaction and wasted everybody's time and money. That would be one, but I think we've covered most of my thoughts on that already. How do you balance the need for thorough due diligence with the need to move quickly in a fast-paced business environment? That's a good one. And I would add to that, what if you're being pitched to put $200,000 into somebody's deal? Are you going to go spend $1 million on due diligence to invest in the $200,000? You are not. So what are some of the shortcuts you could take? There's a reason that venture capital companies operate largely on a portfolio basis, right? We've talked about this before. We do 10 deals. 2 of them are going to go bankrupt. 6 of them are going to bump around and never give us any return. And then we're going to have a home run on 2 out of the 10. And for our whole portfolio, we're going to turn out okay. Just because of those, on the strength of those 2 big deals. All right. And then what nobody talks about is those are 10 deals that were done, but how many did the venture capitalists listen to? Pitches did they listen to before they even agreed to do the 10 deals? Like hundreds of companies presented to them. They financed 10. They succeeded on 2. They have no idea, with all of their sophistication, which of those 2 are actually going to work. What they do know is if they do enough transactions and they manage their portfolio risk, the model works out okay. So if you're an angel investor and you're being asked to throw money into this particular deal, should you take your only $100,000 in the world and give it to one company and have not done thorough due diligence? Does that sound like a good plan? Or should you have a bit more of a VC mindset and think, I'm going to do what I can for due diligence, but I'm going to spread this out on a portfolio basis because some of these are going to work, but some of these are going to fail. And I hear this all the time from angel investors. I don't lose money. I never lose money. Bullshit. Everybody's going to lose money. That's the nature of this business, okay? When you're an angel investor or a high net worth going into private deals, think about it on a portfolio basis. And the other way to mitigate that risk of not having the time or money to do full due diligence is through structure, right? So we talked about the VTB. We talked about holding funds back, right? Again, I buy troubled companies. What if something goes wrong and I have to buy them, next week, right? You get pitched with the deal. It's going down. The bank's coming up. Well, you do your best that you can. You often don't get a lot of time for due diligence, and some of the information you're getting is shoddy, but you can structure your way around that. You can get reps and warranties with holdbacks to help you on that. Often I go in, I've talked to you on this show a million times about going in as first secured creditor of the company that I just bought. So I'm both the bank and the equity holder. Buying it cheap, just going in cheap. Speed is money, right? If you're trying to sell your business next week, you're not going to get as much money as if you're trying to sell your business in a reasonable time frame 6 months from now, right? And so again, as an angel investor, I see this all the time. This company is worth this, but I need the money next week. And they don't expect you to come back and say, well, if you need it next week, it needs to be, 10% of that to cover my risk for exactly this issue. So that's a tough one. It's a little bit circumstantial. And I think that was all of the cut and paste of the comments, questions that I had on due diligence. I believe everything recorded the way that it was supposed to record this time. So there you go. Again, I hope everybody had a wonderful Easter and a very happy Passover. And we will talk to you next week.